The Bogleheads 3-fund portfolio is arguably the most popular lazy portfolio out there. Here we'll investigate its components, historical performance, and the best ETFs to use in its implementation. Hey guys, John Williamson here, OptimizedPortfolio.com, investing and personal finance. The Bogleheads 3-fund portfolio is arguably the most popular lazy portfolio. Bogleheads are followers of the advice and path of the famous Jack Bogle, founder of Vanguard and considered the father of index investing. I am one. The Bogleheads 3-fund portfolio, as the name implies, is a simple portfolio comprised of 3 broad asset classes, usually a U.S. total stock market index fund, a total international stock market index fund, and a total bond market index fund. Bogle suggested the majesty of simplicity. The Bogleheads 3-fund portfolio draws on the idea of portfolio diversification's ability to reduce volatility and drawdowns, protect against black swan events, and maximize risk-adjusted return. Holding multiple uncorrelated assets invariably reduces risk and can result in higher returns and almost always higher risk-adjusted returns than holding one asset in isolation. Interestingly, the Bogleheads 3-fund portfolio does not have a specific one-size-fits-all prescription for asset allocation. The investor is encouraged to choose their own based on time horizon and tolerance for risk. I've got a separate video on asset allocation that I'll provide a link to. For the sake of simplicity here, let's assume a starting age of 20 and a retirement age of 60, yielding an average investor age of 40. Based on that, a reasonable one-size-fits-most 80-20 allocation for the Bogleheads 3-fund portfolio is as follows: 60% U.S. stocks, 20% international stocks, and 20% U.S. bonds. Why index funds? Bogle advocated for simply buying the whole haystack instead of trying to find the needle. Consider these facts. The evidence has shown that even most professional investors can't pick winners that beat the market over 10 plus years, much less the average retail investor like you and me. On the 50th birthday of the S&P 500 index, only 86 of the original 500 companies remained. Blindfolded monkeys randomly throwing darts at stock picks have beaten top hedge fund managers not just once, but consistently. This is why broad index funds like the S&P 500 and total stock market are recommended so often. Specifically, using total market index funds, one can be fully diversified across every sector and market cap size, in this case both domestically and abroad. You can brag to your friends that you own over 10,000 stocks in your portfolio. Why international stocks? At global market weights, U.S. stocks only comprise about 50% of the global market. International stocks don't move in perfect lockstep with U.S. stocks, offering a diversification benefit. If U.S. stocks are declining, international stocks may be doing well, and vice versa. During the period 1970 to 2008, an equity portfolio of 80% U.S. stocks and 20% international stocks had higher general and risk-adjusted returns than a 100% U.S. stock portfolio. I choose to allocate 20% to international stocks in my own portfolio. Taylor Larimore, considered king of the Bogleheads and co-author of The Bogleheads Guide to Investing and The Bogleheads Guide to the 3-Fund Portfolio, succinctly summarizes the Bogleheads 3-Fund Portfolio's benefits as follows. Diversification, over 10,000 worldwide securities, contains every style and cap size, very low cost, very tax efficient, no manager risk, no style drift, no overlap, low turnover, avoids front running, easy to rebalance, never underperforms the market, likely to outperform most investors, and simplicity. Let's explore the selection of assets. For the 60% U.S. stocks position, we have several choices. You could choose to use the S&P 500 index, the total U.S. stock market, the Russell 1000 index, etc. To broadly diversify across U.S. stocks, I'm suggesting the use of a total U.S. stock market fund to get some exposure to small and mid-cap stocks, which have outperformed large-cap stocks historically due to the size factor premium. Vanguard's total U.S. stock market ETF is VTI. Similarly, for the 20% allocation to international stocks, we can use a total international stock market fund like Vanguard's VXUS. For bonds, the obvious and popular choice is a total US bond market fund. But since we know Treasury bonds are superior to corporate bonds, and since a total bond market fund is usually about 25 to 30% corporate bonds, I'm suggesting intermediate Treasury bonds, which should roughly match the average duration of the total US Treasury bond market. At this time, Vanguard doesn't offer a total US Treasury bond market fund, so we can use intermediate Treasury bonds via their ETF VGIT. Long-term bonds are likely too volatile and too susceptible to interest rate risk for older investors, and short-term bonds are too conservative for young investors, so intermediate-term bonds offer a happy medium that is suitable for most investors. For that reason, my blanket recommendation for a one-fund, one-size-fits-most bond choice would be intermediate-term Treasury bonds. That said, I'm actually a fan of the idea of putting the first 20% of your bond holding in long-term Treasury bonds, especially if you are a young investor with a longer investing horizon. The higher volatility of long-term bonds is better able to hedge against stocks' downward movement. We'll illustrate this later on. You can access long-term Treasury bonds via Vanguard's VGLT. Investors can dial in a specific bond duration using a combination of different duration bond funds. Why no international bonds? The inclusion of international bonds in diversified portfolios and target date funds is a fairly recent occurrence. Until recently, costs of international bond fund products were prohibitive for retail investors, and international assets of all kinds were viewed with skepticism until about the 1990s. Vanguard didn't begin including international bonds in their target date funds until 2013. The evidence seems to show that international bonds may offer a small diversification benefit in terms of credit risk on the fixed income side due to their low correlation with both U.S. stocks and U.S. bonds, but there's no compelling reason to think it's any significant benefit. This potential diversification benefit is even less convincing for a portfolio that is not bond-heavy. The infamous Larry Swedroe suggests, based on a 2014 Vanguard paper, that investing in foreign bonds may be prudent for reducing portfolio volatility if and only if the investor can do so with low fees and with currency hedging to eliminate currency risk. Without currency hedging, it's basically forex trading. Luckily, Vanguard's Total International Bond ETF BNDX satisfies those requirements. Vanguard published another paper in 2018 proposing that various local market risk factors such as interest rates, inflation, and yield curves have resulted in relatively low correlations of government bond yields across markets over the past 50 years, suggesting a diversification benefit to increasing the number of global markets in a fixed income allocation. While the research is comprehensive, the tiny diversification benefit they illustrate is negligible in my opinion. Specifically, they showed that for a 60-40 portfolio during the period 1985 to 2013, diversifying internationally with fixed income resulted in a reduction of volatility as measured by standard deviation from 9.5 to 9.4, a reduction of 1%. In short, there's no good reason to consciously avoid international bonds, but there's also no good reason to embrace them either. It's unlikely to help your portfolio, and it's unlikely to hurt it. Bogle suggested that when there are multiple solutions to a problem, choose the simplest one. Samuel Lee agrees, suggesting that utilizing international bonds appears to be a case of diversification for the sake of diversification. If you still do want to incorporate international bonds, don't worry, that's just the Bogleheads 4-fund portfolio. Let's look at the historical performance of the Bogleheads 3-fund portfolio. The backtests here are for the period 1987 to 2019. Portfolio 1 uses the prescribed total bond market. Portfolio 2 is my suggested variation using intermediate treasury bonds. Portfolio 3, particularly suitable for a younger investor or one who desires to assume slightly more risk, uses long-term treasury bonds. As we'd expect, Portfolio 2 with treasury bonds achieves higher general and risk-adjusted returns, lower volatility, and smaller drawdowns than Portfolio 1 that uses the total bond market. Again, This is because corporate bonds are inherently more correlated to stocks. Notice the much higher general and risk-adjusted returns and lower overall volatility of Portfolio 3 with long-term treasuries. It also has a smaller max drawdown. Again, this is due to their higher volatility that is able to counteract stocks' downward movement. Now let's look at the specific funds to use for each of the 3 variations we've explored, using an 80-20 asset allocation. Using entirely low-cost Vanguard funds and the original prescription of a total bond market, we can construct an 80-20 allocation of the traditional Bogleheads 3-fund portfolio pie like this: VTI at 60%, VXUS at 20%, and BND at 20%. Using intermediate-term treasury bonds, the 3-fund portfolio becomes VTI at 60%, VXUS again at 20%, and VGIT at 20%. My preferred version is this one with long-term treasury bonds: VTI at 60%, VXUS at 20%, and VGLT at 20%. I'll provide links to pies for M1 Finance for all these variations. The broker makes regular rebalancing seamless and easy with one click, has 0 transaction fees, and incorporates dynamic rebalancing for new deposits. I'll also include a link to my comprehensive review of M1. I am long VTI and VXUS in my own portfolio. What does your 3-fund portfolio look like? Let me know in the comments.